let Mike step in. This is going to talk a bit about those nearing retirement, so he can explain this slide really good. He created this. He's the CFA charter holder behind this thing. Go ahead, Mike.
Thanks, Brian. So let me give just some quick background. Brian mentioned earlier that inflation is running pretty high right now. Officially, CPI numbers from October were up 6.2% year over year, which is the highest increase in about 30 years. So that's going to translate, into lower real returns in the stock market, stocks, but especially bonds. When you look at bonds, we have low interest rates, and we've had low interest rates, so we're expecting negative real yields on bonds going forward. So it's one thing to say, well, high inflation, let's just add this hyperinflationary asset into a portfolio and we'll be set. But we wanted to look for a way to sort of quantify the importance of adding digital assets and Bitcoin to a portfolio. So what we did was we looked at baby boomers entering retirement, and we feel like baby boomers are probably the most vulnerable investor subset out there right now. Obviously, as you retire, you're not working, so you don't have any wages to help support you. So you have a heavy reliance on your investable assets, your portfolio, to generate a return to fund your life. On top of that, baby boomers have some, unique risk factors. I think chief among them is longevity risk. So when we look at, the advances in healthcare and science, living longer is definitely a benefit to society, but it poses a real financial risk, the risk of outliving your assets. A person who turns 65 in the US, male or female, right now has on average about 20 years of life left to live. And that's a lot longer than previous generations who were, exiting the workforce and entering retirement. In addition, something we found very surprising was the median retirement savings and investment accounts of an individual who turned 65 is only $200,000, give or take. The average is a lot higher, but you got to remember that the average is going to be affected by outliers. So, very wealthy individuals retiring, it's going to push that number up, and it's going to be higher. But the stark reality is 50% of the people who are retiring only have about $200,000 to support themselves, and they've got to support themselves for a longer period of time now, 20 years. So we decided to run, 3 simulations based on some pretty generic, easy to replicate portfolios. We made some assumptions. I spoke about the $200,000 earlier. Social Security benefits coming to an individual about $1,540 a month, and they're expected to have spending needs of about $4,000 a month. For inflation, obviously, as we had mentioned a couple times already, really high right now. We didn't want to make any outrageous projections going 20 years in the future, so we actually kept that pretty conservative at 2.5%, which is, in line with historical numbers. So with that said, if you look at simulation 1, that's just, your traditional 60-40 portfolio, which we feel is the poster child of retirement investing. It's pretty vanilla, 60% stocks, 40% bonds, decent historical expected return, 9.6%. But if you look at the chart, almost none of these portfolios made it 20 years. So an individual investing in this manner isn't going to be able to fund their life if they only have $200,000 going out 20 years. So we took that and we said, okay, let's make a small tweak. Let's rotate 5% of bonds into Bitcoin. And so we're ending up with a 60-35-5 portfolio. You got a expected return about 15.4% now. And if you look at simulation 2 in the chart, we got about 23% of these portfolios are making it 20 years into the future. So whereas almost nobody was making it before, we went from about 0.5% to 23%. A quarter of the people are now able to support themselves going into the future. So that was good. And we thought we'd take it, one small step further and say, okay, let's add another 5% from bonds, rotate that into Bitcoin. We end up with a portfolio that's 60-30-10, expected return about 20.4%. And more importantly, 55% of these portfolios are making it and funding an individual for 20 years. So you go from 0.5% with no Bitcoin, no digital assets, to 23% at only 5% allocation to 55% at a 10% allocation. So it's a pretty stark difference and a pretty, meaningful difference, adding just a little bit of Bitcoin. And, we're not going to sit here and say Bitcoin is, this knight in shining armor that's here to save all investors. But obviously, it has its place in a well-diversified portfolio, and it can make a positive and significant impact at just, a small 5 to 10% allocation.
Yeah, that's great, Mike. And something to emphasize on this is many of you who are maybe 50 plus are having your yearly reviews with your advisor right now, and he probably doesn't have access to Bitcoin, pure Bitcoin. He might be getting you some GBTC, but he's kind of lagged behind in really knowing about the space, and most likely he can't be a fiduciary even when it comes to talking about digital assets. But you might hear him say something, and that's, you need to be safe. You need to be safe. But does safe really help you when you're going to be underfunded at the time of retirement? And, it's risky. Well, we found that when you add Bitcoin to a portfolio, it actually improves the Sharpe ratio. So challenge the norm, look at the best performing asset, and think about making a proper allocation. That way you have a better chance of having your portfolio survive in retirement and properly funding you. Thanks, Mike.
Thank you.
So we'll talk a little bit about